Hello and welcome to another TLC Tutoring Company accounting video. In this lesson, we will be reviewing how to do the gross method versus the net method to account for sales. In this scenario, we will be looking specifically from the perspective of the seller in each transaction. And keep in mind, the major difference between the gross method and the net method is when we are going to make the assumption that the buyer is going to take the discount. So you'll see what I mean once we get started with a few of these transactions. For our first transaction, we have January 20th, and they're telling us that Bella Company sells $40,000, there's our sales price, of inventory with the terms 210 net 30. Here are our credit terms. They mean that the buyer will receive a 2% discount if they pay off the amount due within 10 days, regardless the full amount is due within 30 days. Then they also tell us what the cost of this merchandise that had been sold was to the seller originally. They had originally paid $25,000 for these goods. So as we're getting into the gross method, regardless of the two methods for the initial sales entry, you're going to be using the same types of accounts. So let's start with our accounts. So for the sales price, keep in mind this is a sale and there's a credit terms here, so we know it's on account. So we have two things happening. Our accounts receivable is increasing, and keep in mind accounts receivable is an asset. Ask yourself, is it going up or down? It's increasing. And then I'm going to go ahead and put our little LC cheat sheet here so that we can see that assets increase with a debit. So we are going to start by debiting accounts receivable. The other account that's going to be affected by this sales price is sales. Now keep in mind, sales are going up. That is an income account, so we are going to credit it to recognize it going up. Now for using the gross method does not take into account this discount until the date of payment. So they are going to ignore the discount for now, and they are going to record the amount of the sale at the gross amount. However, if we're doing the net method though, we're using the same accounts, so still accounts receivable and sales. However, in the net method, their assumption is that the buyer will take the discount. So rather than reporting simply 40,000, they are going to take the discount out of that amount. So essentially 40,000 minus 40,000 times the discount percentage. So this way it will be the amount of the sale minus the discount amount, which will be 2% based on these credit terms of the amount of the sale. So using the net method, we see that the amount of our sale comes to $39,200. Now, whether it stays this way, though, will depend on if the customer actually ends up paying within that discount period. In this problem, we are using the perpetual method, so there's a second part of this that we should consider, the cost of the goods that are being sold. They do tell us this. Since we are using the perpetual method here, we are going to record the cost of the merchandise sold. Keep in mind, cost of merchandise sold is an expense, so we're going to debit that expense to increase it. Again, the $25,000 is not going to be adjusted under either method, simply because this is the amount that the seller originally paid for the goods they're now selling. So any discounts that were on that merchandise have come and gone. That's out of the picture now. And keep in mind, this will be the same no matter what method we're using here. All right. Next, we received a return on the 23rd. So they're telling us that Bella Company received a return of some of the goods sold prior to this transaction, and that the amount returned was $10,000. The cost of the goods returned were $8,000. So let's start with our entries. The first thing I usually say when there's a return is consider what you did previously when it comes to your debit and credit accounts. You're essentially going to be flipping what you did before, except for one special little item that we're going to do here to sales. So instead of using sales, we're not going to decrease sales. We're actually going to increase an account called sales, returns, and allowances. And now this account, which is a contra income account, so it increases with a debit, this contra revenue account is now going to increase by the amount of the return. Later, when you do your income statement, it will offset sales so that it will account for those returns. And accounts receivable to recognize that it is now decreasing. Same idea for our second entry in a return. We're simply going to be flipping though. There's no special account here. Now, one thing I do think that we should keep in mind, though, when it comes to returns is please make sure that you're referring to your textbook. For example, I can tell you that when I am teaching the lower level version of this course, this sales returns and allowances and merchandise inventory, or sorry, sales returns and allowances and cost of merchandise sold is not used for returns. They use a special account called customer refunds payable and estimated returns inventory. So if you need to, go back to your textbook, make sure that you are using the appropriate accounts based on what your instructor wants you to do. So it can differ slightly depending on what textbook you're looking at, but in general, we'll record it in the sales returns and allowance account. Now for the amount of the return, it was $10,000. In our case, if we're using the gross method, no adjustment has to be made because the amount of the sale was initially reported at gross. So we are going to record the return at gross as well. However, when we get over to our sales returns and allowances here, we have a little bit of a difference. The sales returns and allowances here is going to be adjusted by the discount. Why? Because we're not going to be giving the buyer credit for amounts that were not charged to their accounts receivable. So if the initial sale was recorded at net, we're going to have to net the return as well. So again, that would be done by taking our $10,000 and minusing out a 2% discount on that $10,000. So that ends up giving them a $9,800 credit. If it helps, kind of think of it this way. If you buy something at 25% off, when you return it, they're going to adjust it by that 25% discount that you received. And that's what we're doing here when we net it by that discount. Now when it comes to the $8,000, again, same idea as it was when we did this account up here. Any discounts on that have already been recorded and dealt with. This is in the past. This is what the seller originally paid for the goods. So that's going to go in without any adjustments, no matter what. All right, here is where we actually get into a pretty major difference between these two methods. If we are using the gross method here, which I'm actually going to change this title real quick to go in that order. If we are using this gross method here, once we get down to the date of payment, we do have to go back and see if it was within the discount period. So here on the 28th, we see that they are paying off the amount owed on their January 20th purchase. Now keep in mind they only get a discount if they pay within 10 days. And yes, they did in fact pay within those 10 days. So they are going to be receiving a discount. So that kind of begs the question, how much would they actually be receiving? Well, let's start with our cash. We know that the seller is going to be receiving cash because they're receiving payment. And the one thing I'm going to start with is keep in mind currently, and this isn't our final answer, but currently they are owed $30,000. However, the buyer is going to be receiving a 2% discount, right? So they were owed 40, they returned 10, now they're owed 30. We're going to have to adjust that by a 2% discount for them, right? So let's take that 30,000 and let's go ahead and decrease it by the amount of their discount. And we find that they're actually only going to be receiving $29,400. Now this presents a bit of a problem under the gross method. Because if we take a look at our accounts receivable account, we debited it for $40,000 and then we credited it for $10,000. So our accounts receivable account actually has a $30,000 balance. So we have a little bit of an issue here. We are going to have to plug the missing $600 here. And the account that we're going to use for the $600 is an account called sales discounts. Similar to sales returns and allowances, it is also a contra revenue or contra income account. So we are going to increase it by debiting it. So it's very, very interesting with that gross method when there is a payment within the discount period. But now once we get to the net method, things are a little bit different. Here, we're still going to be receiving $29,400 cash. That scenario doesn't change. However, when it comes to the accounts receivable, let's go ahead and do the math for that one. We see that we debited it for $39,200, credited it for $9,800. We're done. They equal. That's because we went ahead and assumed that the discount would be taken, so we would be done there. Now that we've taken a look at what it looks like if they pay within the discount payment period, let's go ahead and change that just slightly. Let's assume that instead of paying on, I believe it was January 28th in the other one, let's assume that they pay after the discount period. So they are not going to be receiving a discount. If that is the case, then Bella is going to record again cash received. In this case, they are not eligible for the discount because they paid after the 10-day window. So they are going to be receiving the full $30,000 that they are owed. And again, under the gross method, that is the balance in the account. Actually, let's go ahead and show you the math real quick. Accounts receivable, debit, accounts receivable, credit. The balance in the account is $30,000. So the amount of cash is matching the accounts receivable. Let's see what happens when we go into the net method, however. Again, the amount of the cash received doesn't change. We're still receiving the full $30,000. Sold 40, returned 10. That's $30,000 that we're getting. However, when we take a look at our accounts receivable now, let's find that balance. Debit of $39,200, credit of $9,800. We see that now we are not equaling. We are going to use a special account here for this missing $600 called Sales Discounts Forfeited. And this is simply showing all of the discount amounts that our buyers did not take advantage of when it came to this. So it really does depend on a few things when you're using these two, or when you're analyzing your sales journal entries. One, are we using the gross method or the net method? And two, did they pay within the discount period or outside of the discount period? All right, now that you've had an opportunity to practice this, if you would like to go ahead and pull up the worksheets, I will link to those. They're available on our website in the description. And keep in mind, if there's anything else that you want to see, anything else that doesn't quite make sense, please feel free to let us know in the comments below. Again, thank you so much for watching, and we'll see you in the next video. Happy studying.